Hello everybody, Dwayne Chaba there from DRFX Sport Swing Trading. Today I'm going to take a closer look at the situation on the Kiwi Japanese yen pair to assess the situation that has been forming over the last several weeks and identify any trading opportunities that can present themselves for us over the next few days. Now, as we can see, taking a look at the daily chart, this uptrend has been in place since 2012. But based on the patterns that we have been seeing since 2014, this trend appears to be coming to a gradual end, and based on the pattern which has been formed, which is typically referred to as a bear crown or head and shoulders formation, we are very likely to see a gradual break of this trend line and this pennant setup that has formed the right tip, and then to lead to the start of a downtrend in favor of the Japanese yen over the long term. This could take us into 2016, 2017. And based on the setup and based on the fact that these types of setups are normally associated with major trend changes, this downtrend has a very large possibility, a very high possibility of taking place and starting over the next few days. So zooming in, we can take a look at the pennant setup that has formed this right tip. As we can see here, that we're now back at the support after moving within the boundaries of resistance and support that led to the ultimate formation of this pennant. So it is very possible that by the end of the week or heading into the second week of May, that we see a strong bearish breakout, simultaneous breakout of the support boundary as well as this major uptrend line. If that is the case and we get a strong normal candle that would probably look something like this, then assuming that it has the appropriate setup on the 4-hour chart that conforms to all of the parameters in our trade sheet, we could be able to capture 200 pips from this expected decline over the next couple of days. If the candle and the setup are such that we will be entering as soon as this candle appears at the close of this candle at the 88, just above the 88 area, that 200 pip would lie somewhere in this region. And based on that target, it would not take a very long time for that target to be hit. One, because of the fact that we're in consolidation, and consolidation breakouts tend to move pretty quickly. And two, given the size of this pennant, the breakout equivalent is likely to lie somewhere within this region here. So it wouldn't be very hard for us to capture those 200 pips within the context of the fact that the movement is going to be pretty fast and that the market is not likely to take a pause until it reaches its breakout equivalent, which will be somewhere around the $83 area as well. So we're looking at a very strong trade possibility that can arise over the next few days. We just continue to monitor it and take a look at what are the patterns that unfold. It is possible that instead of a breakout in the next few days, the market continues to move within this area before breaking out. It is still possible at this stage, analyzing this chart pattern by itself alone, that there's an equal possibility that we actually have a breakout in favor of the Kiwi, but that has a very low probability of actually leading to any significant gains for the Kiwi because of this sideways movement and because of this bear crown setup. and a large size of this bear count setup, it is more likely that this is going to be the ultimate direction of the bear over the foreseeable future, heading into 2016, 2017, 2018. So let's monitor this chart, let's monitor this pair, and hopefully we can get some lucrative trades, or at least one lucrative 200 pip trade from this expected downtrend.